Is artificial intelligence really a bubble, or is everyone looking in the wrong place? This is the story of trillion-dollar promises, of deals that finance each other, and of a dangerous system where almost no one asks, who is actually going to pay for this? In reality, this story is not new. In 1999, people believed in a single word, .com. In 2008, they believed something else. This time, the system won't collapse. And today, we may be living under the same hypnosis again, driven by a single word, artificial intelligence. Everyone says it's a revolution. But do revolutions make investors rich? Or does the way revolutions are priced end up making investors poor? Technology can be real, but prices are not always real. At this point, we need to ask a simple question. If a company earns $20 billion a year, how can it promise $1 trillion in spending? This isn't just about big numbers. The real issue is how the system works, because these expenditures don't happen in isolation. Each one feeds another company's revenue, another company's investment, another company's balance sheet. To make it concrete, Microsoft invests in OpenAI. OpenAI uses that money to buy services from Microsoft. Microsoft meets that demand by buying chips from Nvidia. Nvidia uses that revenue to invest in OpenAI. And the cycle starts again. Money moves from one company to another, but it becomes unclear who is creating real final demand. This is exactly where the fragility of such systems appears. As long as everything works, no one sees risk. But when a single link breaks, the entire structure shakes, because these expenditures are not based on real end-user demand, but on interconnected agreements. That's why it's no coincidence that some executives are starting to talk about public support behind the scenes, because the private sector alone may not be able to carry this scale of risk for very long. And at that point, the nature of the game changes. The real underlying problem is this: no one sees the entire chain. Everyone believes their own part is working. But a system is only as strong as its weakest link. And when that link breaks, recovery becomes very difficult. At this point, we need to make an important distinction. DeepMind, AlphaFold, genomics research, drug discovery. These are real scientific breakthroughs. But on the investment side, we still have to separate two things. A scientific revolution and a stock price are not the same thing. The same arguments were made during the .com era. This time is different. The internet will change everything. They were right, and investors still lost money, because the technology was correct, but the pricing was wrong. Today, artificial intelligence carries a similar risk. Scientifically, there is an extraordinary leap forward. But stock prices are buying that future today as if it were already perfectly realized. When we look at every major bubble in history, we see the same pattern. First, there's a reasonable story. Then, that story gets priced in. Finally, prices move ahead of the story. In Tulip Mania, it was a flower. In the South Sea bubble, it was a trade fantasy. In the .com era, it was the internet. Today, that role is played by crypto and artificial intelligence. The story may be true, but the pricing is often exaggerated. The role of the media in this process should not be underestimated. The media loves rising markets. Headlines talk about a new era, a new economy, a new paradigm. Critics are labeled outdated, but bubbles never burst because of criticism. They burst when criticism disappears. Because at that point, no one is talking about risk anymore. And this is where the most dangerous phase begins. People start to see every decline as a buying opportunity, because the story is still strong. But in every bubble, at some point, the story doesn't change. The price does. And when prices fall, the story doesn't save anyone. Even the phrase, "I'm a long-term investor," fails to protect you. Being right in the long run does not prevent losses if you buy at the wrong price. This is where a simple but brutal rule from Buffett's investment discipline comes into play. Don't buy what you don't understand, because risks you don't understand will catch you at the worst possible moment. What we're seeing in artificial intelligence today is exactly this. The technology is extremely complex. Business models are not yet clear, but prices behave as if everything has already been solved. Yes, there are opportunities in AI, but there are also excessive expectations. When that balance breaks, the market can react very violently. The AI story will not end. But today's prices may not be permanent. Those who can separate the story from the price will survive. Those who cannot end up investing in the narrative, not the valuation. In the end, the market always teaches, but the lessons are expensive. Those who are patient today may see opportunities more clearly tomorrow. Those who rush are usually the first to learn the lessons. Because history shows one thing very clearly. Complex financial structures always collapse for a simple reason. At some point, the money runs out.